It's such a wild market right now. It is so varied, and the economy is so in question, and everybody's worried about it. But it seems to be still going along, and there's definitely still this dichotomy of winners and losers, and it's hard to point out why some brands are doing better than others. I think the casual dining sector is struggling the most, but fast food is having some trouble. And what's remarkable is some of the high end places are still doing really well. So you kind of see a big mix, and it's hard to make any generalizations about it. There's a lot of brands that are growing. There's a lot of brands that still have, their numbers are good, their unit economics are good, and they've got backing, and they're looking for real estate. And there's other ones, as we see, fat brands, there's other ones that are just going to have to, consolidate and pull back and close units. So it's a very much of a mixed bag right now, and very difficult to say anything general about any of it, except that watch each brand individually, because they're all weathering this uncertainty in different ways.
How will the Saks Fifth Avenue bankruptcy affect restaurants? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with Stephen Cohen, a real estate attorney who does a lot of work with restaurants. We wanted to speak with Stephen about the real estate implications of the Saks Fifth Avenue bankruptcy. No, Saks is not a restaurant, but it does own a few of them. But mostly it's a major real estate tenant with some 8.4 million square feet of space. Many of its locations are in malls populated by a lot of restaurants. We wanted to talk about the implications this could have on the restaurant industry, particularly those in and around malls, both for good and for ill. Stephen talks about the potential implications for foot traffic in some malls and potential opportunities for certain restaurants to get available space in some desirable shopping centers. But we also talk a lot of other topics, including various real estate trends and the opportunities and risks in second generation sites or closed restaurants. We're talking malls on A Deeper Dive, so please check it out. All right, I'm here with Stephen Cohen. Stephen, welcome to the podcast.
Thank you. Great to be here.
All right, so here's an interesting topic. Saks Fifth Avenue and its various subsidiaries filed for bankruptcy earlier this month. How is that affecting restaurants from a real estate perspective?
Well, there's going to be a number of different effects on restaurants, depending a lot on the specific locations of the Saks stores and of the restaurants themselves. The immediate impacts can be hard to know or feel. There's no immediate closures of stores. There's already been a drop off in traffic in a number of them, which is what's causing the bankruptcy. So stores may have already been feeling that. Some of the restaurants may have already been feeling that. That may continue as things go on if they have problems getting inventory, and they will be closing units. And once they start closing units, that can affect the local restaurants that are dependent on that foot traffic. So that'll be the immediate and the close time effect of the bankruptcy. And then we should also talk about some longer term opportunities that it may present for restaurants that are looking to grow and acquire real estate.
So how would it be an opportunity for restaurants?
Well, a number of these particularly the Saks off Fifth brand there's going to be some closures. They have, I believe, 70 units in that brand. The going wisdom is about half of those are going to close. They're usually, I think, 20 to 30 to 40,000 square feet. So that's a significant amount of real estate that's going to come back on the market. The landlords are lucky and they're smart. They'll backfill them with other big box users like a TJ Maxx or Five Below. They may cut them up and put them into smaller retailers. But some of those may get demoed and repurposed, and then there'll be, pads for restaurants, because that's kind of the trend of the demalling of America.
Right. Well, you've seen a number of examples in which certain types of restaurants become almost an anchor. I think Dave & Buster's has done this in particular, but we've seen a number of other concepts, or certainly certain types of large scale concepts that were able to take over as anchors or like sort of co-anchors in some of these spaces.
Yeah.
Because obviously they're too large to be like a Noodles and Company, but a Dave & Buster's or many of these sort of so-called entertainment concepts have had some success moving into some of these vacant spots, and the malls want them.
Yeah, and some of them are, Cheesecake Factory, PF Chang's. I mean, there's a history of some of these bigger restaurants that can go in and take down sizable square footage. Generally, it's hard to repurpose a department store. So usually it's a demo and rebuild, but so what? That works for everybody. And it's some of those units are pretty old anyway. So it's a great way to bring some new life to a mall.
Yeah. I mean, you kind of talked about the demalling of America. And I think the concern that I have with a bankruptcy like this, it's another department store filing for bankruptcy and closing locations. And the mall the mall has sort of grown to be where, I mean, look, the mall has grown to sort of around these types of companies, where you had like your Saks Fifth Avenue, your Bloomingdale's, your Belks, et cetera, et cetera, et cetera. And they would operate as anchors for the mall to draw traffic in. And these malls have had to adjust because so many of them have gone under or closed locations. I think the Mall of America, where I live, I think started out with like 4 anchor tenants, and I believe they're down to 3, if not 2 at this particular point. You've seen this all over the place where these companies have to sort of bend themselves. These real estate companies have to sort of bend themselves into pretzels to try to figure out how to fill some of these spaces. And it's had a corresponding impact on mall traffic. It just seems to be a giant headache.
This is a trend that's been going on for quite some time. I mean, if you think about the old traditional mall with the 4 anchors at J.C. Penney's, at Sears, at Macy's, Dillard's, or something like that. I mean, nobody's building those anymore. If anything, they're one by one, those anchors are falling away. I think we call them anchors. I think about them as what they're anchoring us to is the past. They're not really anchoring the mall anymore. Now the malls are being anchored by, you said, like the entertainment business, and even movie theaters still, and some of the high powered, high volume restaurants. I mean, those are really the anchors that mall owners want now, because that's really what attracts the traffic.
Right. Yeah. I mean, in many respects, that's like they've replaced a lot of these department stores with restaurant companies. What's interesting about this bankruptcy, I mean, like Saks is a substantial real estate holder. I mean, I think I was looking at their bankruptcy documents, and they have like 8.4 million square feet or something like that of retail space around the country. It's a really big tenant of a lot of developments. And, so many of these developments are higher end malls. And that, you could have a company in this scenario that says, all right, we can't make money at this particular mall. It was a higher end mall that seemingly was doing okay. And now they might, they're in danger of potentially losing, a key anchor tenant that creates problems at some of these higher end malls that in theory had been sort of immune for this problem. So it's almost expanding it to a different type of real estate, is it not?
Yeah, Jonathan, I think most of the closures are going to be in the outlet malls and the B malls. I don't suspect that those top A malls are going to have. Maybe they'll lose a Neiman Marcus here or there, or a full line Saks. But I think most of them are going to be the B market and the outlets. But it's still a trend, across the country, and it's been going on for decades. And an anchor goes out, and very often what happens is it gets demolished, and then they build a little lifestyle segment to their mall, and they populate that with restaurants. And I've seen a lot of deals that way, and I would suspect we'll see some more of that.
Right. Now you're familiar, obviously, with the Twin Cities area where I live. We have the mall nearest me is a mall called Rosedale. You're familiar with that one?
Sure.
That's actually almost a lab. It's the second busiest mall in the state, and it's almost a lab for sort of experiments and how a company sort of evolves. They have been very creative with some of their anchor tenants. They've established, sort of a food hall that is kind of working-ish. They replaced one of their anchors, a Herberger's, with a Dick's Sporting Goods. But they also have these out. They have a lot of, almost as your point, and almost a little lifestyle section where you can access certain brands outside of the mall. So you can go into a Williams Sonoma and not actually have to tolerate all the other nonsense that's inside of the mall. So I mean, watching these, and then by the way, the outside of the mall, they have shoehorned so many restaurants
Yeah.
on on outlots, created outlots that you would never even imagine there would have been an outlot. So there is a Panera Bread right smack next to a Shake Shack with a drive-through, and they're shoehorned in there. There is a Raising Cane's and a Portillo's right next to a small little strips section on the other side of the mall. And it's, I can't even figure out where they fit the queues for the drive-throughs in some of these things. Um,
I'm seeing this a lot, Jonathan, across the country, and malls are looking at their parking fields and going, we actually have less square footage than we had before, so we don't need as much parking as we had before. We'd rather have a Chick-fil-A or Raising Cane's, and they'll somehow squeeze a bunch of outlots with drive-throughs right into their, what was formerly their big parking lot. They, if they're complying with code and they're complying with their REA and their restrictions, they can do it. And it's a great way for them to add value to their mall. And it's a great opportunity for restaurants.
Right, right. Yeah, I mean, it's actually pretty funny. A Raising Cane's right next to a Portillo's in a pair of outlaws, both with drive-throughs. It's probably like $14 million worth of fast food restaurant right in that particular spot. You could probably walk about 10 spaces to get from one to the next. It's actually pretty extraordinary. So the level of creativity simply in whoever is doing that must be really good at puzzles. That's my perspective. So, but it's also kind of interesting to me to see that, the malls have not only evolved, but we've seen, a lot of mall traffic, a lot of mall-based brands have not only survived, but almost thrived in sort of this post-pandemic mall period. So you got chains like Annie Ann's that is doing quite well. Sbarro, for some reason, is on this comeback trail despite 2 bankruptcies, which one of more extraordinary things. It's hard to survive 1 bankruptcy and not go into a long-term decline. Filing for 2 bankruptcies is, I mean, you would have expected they'd have practically be dead at this particular point. And a lot of these brands are actually finding ways to evolve beyond the mall and stuff like that. And it's been fascinating to watch, but we still have this almost ongoing challenge of where we could see a big bankruptcy and that creates some more headaches for some of these concepts.
Yeah, some of the brands have staying power that just still is remarkable. And some of the legacy brands are still hanging in there. And it depends a lot on how adaptable they are. It depends a lot on how leveraged they are. Do they have flexibility to take opportunities where they can go outside of a mall, inside of a mall, in a lifestyle center, in a mixed use project? Sometimes the more flexibility they have, the better their staying power will be.
Right.
And a lot of it's management, Jonathan. I mean, a lot of it's, it's easy to talk about a turnaround, but it's really hard to pull off.
Yeah.
And some people can do it.
Yeah, that is very much true. I mean, how you manage a turnaround really depend, or how a turnaround succeeds really depends on how you manage it. And I would say, especially when you have a company that files for bankruptcy like that, most of the time, the companies that take these things over are really just looking to to generate to take the cash and they'll cut costs, they'll take cash out what they can. When they need to close a location, they'll close it. They will not put in really the work that is required to get these brands back on their feet again. That's a clear case in Sparrows. They took the opposite approach and they've got a guy in there who is acquired the company and is doing many of the right things that you're supposed to be. So it's certainly possible to take a company out of bankruptcy and make it grow, especially if it has a well-known enough brand name. So yeah, I mean that's a very good point that you bring up.
I mean, I don't think I've ever met a CEO who didn't think he could turn around a company. I mean, operators are big believers in themselves, and it's easy to look at an existing brand and existing company and go, well, and look at all the things they're doing wrong, and think about what you would do to make it better. And sometimes you'll make it better, but that doesn't always get you out of that trouble that you were in to begin with.
Yeah, yeah. No restaurant executive ever says our plans are terrible and we're going to fail.
That
They
doesn't
are
happen.
all uh, they are all very confident in the ability of their plans to work. That is pretty much universal. So, shifting gears a little bit. So, what are you seeing on the real estate front? Right, what's anything you're concerned about right now?
It's such a wild market right now. It is so varied, and the economy is so in question, and everybody's worried about it. But it seems to be still going along, and there's definitely still this dichotomy of winners and losers, and it's hard to point out why some brands are doing better than others. Even by category, I mean, I think the casual dining sector is struggling the most, but fast food is having some trouble, and what's remarkable is some of the high end places are still doing really well. So you kind of see a big mix, and it's hard to make any generalizations about it. There's a lot of brands that are growing. I mean, there's a lot of brands that still have, their numbers are good, their unit economics are good, and they've got backing, and they're looking for real estate. And there's other ones, as we see, fat brands. There's other ones that are just going to have to, consolidate and pull back and close units. So it's a very much of a mixed bag right now, and very difficult to say anything general about any of it, except that you watch each brand individually, because they're all uh, weathering this uncertainty in different ways.
Yeah, it's a weird economy,
It's very
especially for us.
weird. Yeah, I mean, there's a lot of the issue is there's a lot of uncertainty about what's going to happen. So there's kind of this sense of what's around the corner. So it makes it very difficult for companies to make long-term decisions. And depending on what kind of brand, what kind of concept you are, that can have a big effect on your strategy. So if you're a fast casual guy and you can, build out a store in 6 months, great. You're going to grow. Like Wingstop's growing like crazy, right? There's those guys can grow, and they're not that worried about what's coming down the pike, because, it's going to be quick. Some of these guys that take a year or two to develop their restaurants, I mean, how do you know? And if you put it on hold, then 2 years from now, you got nothing. So you kind of have to develop go into the dark and just, leap of faith and say, well, our unit economics are still good, and we've got a good piece of real estate. Whatever happens, we'll be there for it.
Wow, yeah, yeah. That has to be a significant challenge because things can turn on an absolute dime in the industry. I kind of go back because we mentioned the fat brands. Fat brands filed for bankruptcy, $1.45 billion in secured debt. And, they took on the debt that they had in 20 and 21 at the time when, say what you will about Andy Wiederhorn, but they had a reasonable expectation that they were thinking along the same lines that a large number of other buyers were at the time, which was that, the industry has emerged from the pandemic, should be fine. And, we'll be able to, their thing was they would be able to renegotiate their debt 2 years down the line. That was their actual plan. And that all fell apart within a very short period of time. We went from, I think it was, if I recall correctly, in 21, I think it was sort of like September, October timeframe. We were thinking that there were about 8 companies that were planning to go public, for instance, in about the September, October timeframe. So, and by December, all that was off. And the economy, the assessment of valuations in the restaurant industry changed on the dime. And that's not very uncommon today, actually. Something could happen. I mean, how many times have we had a black swan event just since 2020? I mean, how many of them? We could probably think about 3. Right. So we've had so many of these events that have taken place that have really interrupted the restaurant space. And to your point, if you're developing a restaurant a year plus down the line, to a certain extent, just by the very nature of building a restaurant in 2026, you're taking a big risk that something changes that completely alters the valuation metrics within a short period of time.
And I think what that really points to is for operators is the warning against getting over leveraged, because once you've over leveraged, there's no way out of that. And so, the best protection against the economy and all the things we don't know about is not to be over leveraged. So that if there's a dip, you're like, okay, this sucks, but I can still pay my debt. And I mean, I think if you go back to the Saks bankruptcy, you look at that, I think they listed $1 billion in assets and $10 billion in liabilities. I mean, they took on a tremendous debt to when they acquired Neiman Marcus. And, that's just bold, but, maybe in retrospect, not the right thing to do.
No. Well, I mean, there was in the restaurant space, we also had the bankruptcy of the Popeyes franchisee Sailorman. And we want to talk about leverage. I mean, they had $130 million in debt on about 130 some total locations, but many of those locations they would build and open and then do an immediate sale leaseback was a very common strategy for them. So, like, to me, like your leverage point is absolutely spot on. It's when you take on way too much leverage for whatever reason you're doing that, you are putting yourself at risk within a few years of whatever. And and we're seeing it happen over and over and over and over again, really for the past 3 years. I think we're just seeing bankruptcy after bankruptcy after bankruptcy, and a lot of it was sort of an outgrowth of the overly aggressive post-pandemic period in which companies just felt that, well, these good times are going to keep rolling for several years. Apparently not.
I think it also depends on who's driving the bus, so to speak. I mean, if you're a publicly held company, you're being driven by Wall Street to up your store count. If you're private equity, they want to pump up the store count so they can flip it and sell it. So it's kind of a gamble. They're not doing it for long-term strategy. It's like, let's get this thing pumped up and then we're gonna sell. But if they don't get their timing right, then all they have is a lot of leveraged debt.
Right. Yeah, no, that is accurate. So, like, one other thing that we're seeing, like, obviously, the past couple of years, we've seen an elevated number of closures, and now we see a lot of companies that are using as a primary form of expansion going into some of these closed restaurants. Is that what you're seeing, and any concerns about that at all?
No, I think it's a good opportunity for operators that have some flexibility to go and take over existing restaurant space. I mean, just the bones of the thing will be there. Your hoods and your grease traps and all the pieces that you're going to have in place that you wouldn't have if you're taking over a shoe store or you're doing a new build out. So it definitely helps with the cost of the build out. It definitely helps with the timing. And if you can be flexible on your footprint, there is a lot of opportunity there. If you're tied to being exactly 1,250 square feet and you need to have the utilities in certain places, that's going to limit you. But I think it's good for restaurants who are creative. I think it's good for the landlords and for the real estate because it's usually a quick turnover and can get back reopened. It doesn't sit there as a zombie store for very long. And so I think going into previously occupied space is usually pretty good, unless it's the second, third, or fourth time round for that specific location. Then that place is jinxed. Don't bother going there.
Right. Well, I mean, that's a great point. I mean, to me, there are second generation sites, and then there are second generation sites. It's like just because I mean, it almost gets back to your point sometimes about overly confident executives, where people think, oh, I can make this work, and then they go into a site that's been 3 different restaurants in the past 7 years or something like that, and then of course they fail. Like, oh, well, why'd that happen? I mean, sometimes there's a reason why a site didn't work, and it's not all based on brand metrics at the concept that was operating there in the first place. Sometimes there's a reason why these restaurants had to close. So that to me is always sort of the risk in that, is that it's not, it's cheaper to get into the site and to open a location there, but it's also cheaper sometimes for a reason. And that's always the risk to me in that.
Yeah, I mean, some sites are just jinxed. they're for, and you can't even say what the reason is, except that maybe it's been through too many rounds too quickly. And, and you're right, though. There's some second generation space. That's perfectly legitimate and makes good sense. And I've been around the block enough times now that I've done the same exact different deals for the same exact location. I put one restaurant in there. 10 years later, they go away and I put another restaurant in there, and it's the same exact location. And that's not a jinx site. That's just, they had a good 10 years. They decided to pull the plug, and somebody else liked the site and went in and took it.
Yeah. That's a big issue, I think, for independent restaurants where somebody wants to start a restaurant and they see an open site and, they think, hey, I can make it work there. And then you look under the, and then you look under the hood a little bit and you find out that it's been like 8 different restaurants over time. And, sometimes it can work. I mean, actually, you've heard of the brand Snarf Sandwiches. It's actually one of the fastest growing restaurant chains in the country. And it was started out of Colorado by a guy who opened in a location that was literally 8 different restaurants at one point. And then it worked. So here I am preaching not to do that.
The exception of the rule.
Yeah. But I mean, it happens all the time where they go into restaurants. It's just a warning sign that you got to make sure that the site, I guess, is that right? Make sure that the site, they're not site problems or, but really that this is something that your brand could still work in that particular location, right?
Yeah.
What's the strategy there?
Yeah, I think in those situations, it pays to really do some homework to figure out why the prior concepts that were in there didn't work. And I don't know, how you do that study of the neighborhood or the community, but that would be really good information to have.
Right. Superb. Stephen, this was fantastic. I really appreciate you joining me this week on the podcast.
Always good to see you, Jonathan.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Himes. You can find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. But by all means, subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.